My name is Mark Cormack. I'm a Director of Distribution at Pinnacle Investment. Look, it's great to be back with our Australian companies reporting season and dividend analysis so that we can keep financial advisors updated and ahead of the curve. Look, today I'm delighted to be joined by Dr. Peter Gardner, a Senior Portfolio Manager at Plato Investment, whose primary responsibility is managing the Plato Australian Shares Income Fund. Pete, thanks for joining me.
Thanks for having me, Mark.
Look, let's kick off with mining giant Rio Tinto, who disappointed investors with halving its interim dividend despite better than expected results.
Yeah, you've pretty much summed it up with that, Mark. Their result was pretty good. It was just above expectations, profit of $8.6 billion US, which is down 29% on this time last year. However, you've got to remember last year, iron ore prices were about $180 US a ton, whereas now they've dropped to currently around $100 US ton. So yeah, so it's still a pretty good result from Rio given those drops in commodity prices. However, yeah, you're right about their dividend. When you include the special dividend they paid last period, it was a cut of 50%. But after saying that, it was still a 5.5% gross yield, which is pretty good for just this dividend. They paid out just 50% of their underlying earnings, despite paying out 84% last year. So they decided to be a lot more conservative in that regard. And their fortunes going forward are largely dependent on what happens in China with regards to COVID lockdowns and also whether the government's going to support their property, which has been under pressure. We think we've got a bit of a property crash in Australia, but it's a lot worse in China at the moment. And also the impact of interest rates on global economic growth and how that affects commodity prices going forward. But overall, a good result from Rio, albeit a bit of a disappointing dividend.
Look, it hasn't been all bad news so far in reporting season, with CBA boosting its final dividend to $2.10. Take us through their result.
Yeah, it was a good result from CBA. Their profit was up 11% on last year and 4% above expectations to almost $10 billion for the year. Their interim dividend, as you say, was increased 5%, which is a good 3% gross yield for this dividend. They paid out just 68% of earnings, which is slightly below their target of 70 to 80, but that's because they took out the impact of their ability to return some of those bad debts or those COVID provisions that they built up during the COVID times, which shows you how many provisions they built up that they're still returning to shareholders over 1 year later. That interest margin was slightly below expectations due to what they say is increased competition in the market, and NAB also highlighted that at their result, which actually caused CBA to be a bit more conservative. They actually only grew at just below the normal system growth in home loans. They grew at 1.3 times system in business lending, so they grew a bit stronger there. But the reason they decided to grow a bit weaker was that they didn't want to overly compete with their competitors who are being a bit, in their terms, irrational in the current market. However, what they've highlighted, the result, which they highlighted back in February as well, was that they get a 4 basis point benefit in net interest margin for every 25 basis point increase in the interest rate of the RBA. And so if you say the RBA has increased interest rates by 175 basis points, and it'll be more going forward, that's already given them a margin benefit of 28 basis points from the interest rate cuts, and that'll interest rate increases, and that'll improve going forward as well. So a good result from CBA, and we expect it to get even better in the upcoming periods.
Okay, while we're talking financials, Suncorp and QBE reported, and look, we're all feeling it with increases in insurance premiums. Any joy for dividends and shareholders?
Not in this current period. So that both the earnings of Suncorp and QBE were actually down versus what they were on last year, albeit both of them were slightly above expectations, given what's been happening with natural hazards for Suncorp. We all know about La Nina causing floods on the East Coast, and that significantly impacted their earnings. And also with QBE, what's happened is that as interest rates increase, that'll be really positive for QBE going forward in terms of their ability for investment earnings, because they invest a lot of those premiums they receive at the start of the year in bonds. However, when you talk about interest rate increases, that actually causes the value of the current bonds to be marked down to kind of market levels. And so that's actually impacted QBE's current level earnings. But obviously, the market's going to look through that, given the increases going forward. And so the QBE in particular has responded pretty positively to its result. Their dividends are a bit below expectations, but it's worth noting, as you say, that premiums are up very significantly. And so in Suncorp's case, premiums are up 9%. In QBE's case, they're up 10%. And so that bodes well for future growth, especially if you start seeing La Nina to turn around. and turn into an El Nino and claims to return back to normal, that'll be really good for their profitability going forward.
Okay, look, one final question. Former dividend darling Telstra just reported this morning. Any early insights?
Yeah, it was a really good result from Telstra. It was the top of expectations. Profit up 8% on the prior period. It's been a while since Telstra's had an increase in profits over the year. They strengthened their FY23 guidance to $7.8 to $8 billion. So they're forecasting further increases in profit going forward. And as you say, their dividend was actually increased, which is the first time in 7 years. So those long-suffering Telstra shareholders that have had to have cuts in dividends, we've finally seen an increase, which equates to a 3% gross yield for this dividend. Now, the jewel in Telstra's crown is obviously their mobile services, where their EBITDA was up 21%, adding 215,000 customers, which is a pretty good result for Telstra, given Australia's population didn't move much over the last year. And their 5G network is still sitting very good compared with their nearest competitor, with twice the coverage and a lot more devices connected to that mobile network. So overall, a good result for Telstra. Shows the need to move around, where we've been negative on Telstra for quite a while, but over the last year we've become a lot more positive given their profit forecasts are improving going forward.
Thanks, Pete. Great update so far in reporting season. But just a reminder that financial year 2022 saw the Plato Australian Shares Income Fund deliver over 15% gross income, which includes dividends and franking credits, versus the index grossed up for dividends and franking credits of around about 5.5%. It's also important to remember that the fund, the Plato Australian Shares Income Fund, outperformed on a total return basis too. As always, Plato shows that there's plenty of income in Australian equities. You need to be tactical, nimble, and know where to look. If you are after any further information on equity income investing, please do not hesitate to contact the Pinnacle Investment Team or refer to the Plato website, www.plato.com.au. Thanks for watching and have a great day.
Thanks, everyone.